Buying your first house? There are 4 main types of home loans that you can choose from, and picking the wrong one can cost you tens of thousands of dollars over the life of the loan. Or worse, it can stop you from buying a house at all. Today, I'm going to break down all 4 in plain English with no fancy words, and by the end of this video, you'll know exactly which loan fits your situation. Real quick, I'm Michael Saveth. I'm a lifelong Tulsan, a Tulsa Realtor, and I help first-time buyers in this city pick the right loan and connect with the right lender for their situation. I don't make the loans myself, but I have a handful of Tulsa lenders that I trust, and I know which ones fit which buyers. So if you're ready to finally get serious about home buying and you want help figuring out yours, the link to book a call with me is in the description below. All right, let's go ahead and get right into it. Okay, loan number 1 is FHA, which stands for Federal Housing Administration. This is the loan that most first-time buyers end up using, and here is why. The down payment is extremely low, 3.5%. So on a $250,000 house, that's about $8,700 down. Compare that to 20%, which is 50 grand. I would say that's a hell of a difference. The credit score requirement is also low. You can qualify with a credit score as low as 580. Some lenders even go down to 500, so you can put 10% down. That is absolutely huge because a lot of first-time buyers, they have not built up perfect credit yet. Here's the catch. FHA loans come with mortgage insurance. It's called MIP. You pay for it every month on top of your regular payments for the life of the loan in most cases. It's the cost of getting in with less money down. So on a $250,000 loan, you're looking at about $150 extra a month, and that adds up over 30 years. Best fit for FHA is if you are a first-time buyer. Credit's decent but not perfect, and you don't have a huge down payment saved up. You want to get into a house now and refinance later when your credit improves. So that's loan number 1. Loan number 2 is conventional. This is the default loan that most people think of when they hear the word mortgage. It's not backed by the government like FHA. It's a private loan, usually backed by Freddie Mae or Freddie Mac. Down payment can be as low as 3% if you are a first-time buyer. 5% is more common, and 20% gets you the best terms and removes the need for PMI. Quick word on PMI, which stands for Private Mortgage Insurance. If you put less than 20% down on a conventional loan, you pay this every month. The good news, unlike FHA, you can drop PMI as soon as you hit 20% equity. So if you buy at 5% down and your house appreciates or you pay down the loan, PMI eventually goes away. FHA's MIP usually does not. Credit score requirement is higher than FHA. You typically need 620 or above, and the better your credit, the better your rate. So here's the best fit for conventional. You've got decent credit, ideally 680 or higher. You have at least 3 to 5% saved up for a down payment. You want flexibility, fewer restrictions on the property, and the ability to drop mortgage insurance later on. Real quick reminder, if you're sitting there watching this and thinking, I have no idea which one of these fits me, that's exactly what I help my buyers figure out. The link to book a call is in the description below, and we will talk you through your situation, and I will point you to the right lender from my network. All right, let's go ahead and get back into it. So loan number 3 is VA, which stands for Department of Veteran Affairs. If you served in the military, this is going to be the best loan you can possibly get. Hands down, no question. And here's what makes it incredible. 0 down payment, literally 0. You can buy a house with literally nothing out of pocket on the down payment side. No PMI either, and here's the kicker. Most loans, they charge you mortgage insurance if you put less than 20% down. VA loans, they don't charge any of that. The interest rates are also typically lower than conventional or FHA because the government backs the loan. The lender takes less risk, so they give you a better rate. Now, who qualifies is active military, veterans, National Guard and Reserves who meet service requirements, surviving spouses of service members in certain situations. Also, even if you served 20 years ago, you still may qualify for this for life. However, just like the others, there's a catch. It's called a funding fee, and it's usually 1.25% to 3.25% of the loan, but it can be rolled into the mortgage so you don't have to pay out of pocket. And some veterans with service-connected disabilities are exempt from the funding fee entirely. So to recap on this, best fit for VA is you served, in the military or you're currently serving in any branch of the U.S. military, period. If that's you, this is the loan that you should be looking at first, hands down. And last but not least, loan number 4 is USDA, which stands for U.S. Department of Agriculture. This one's the surprise. Most people have actually never heard of it. USDA loans are designed for rural areas, but here's the twist. Rural, by USDA's definition, is way bigger than what most people think. A lot of small towns and even some suburb adjacent areas around Tulsa Metro or your home qualify. Places people would even think of as rural at all. If your house qualifies, here is what you get. 0 down payment, just like VA, no down payment at all. Lower mortgage insurance compared to FHA and competitive interest rates. However, just like a few others, there are some catches. Your income has to be under a certain limit for your area, usually 115% of the local median income. The household has to be in a USDA eligible zone. It has to be your primary residence, not a rental. So the best fit for USDA is you're buying outside the main Tulsa metro core. Again, think small towns, semi-rural areas, places off the main highway. Your income's moderate, not super high. You don't have a big down payment saved. You want to get into a house with 0 down and don't need to be in the middle of the city. Okay, so that is all 4 loans. Now, here's the thing. Those are the 4 main loan types that you'll find anywhere in the country. But Oklahoma has some loan programs that most buyers in this state, they don't even know exists. I'm talking about programs that can drop your down payment to almost nothing, give you grant money that you don't have to pay back, and stack on top of FHA or conventional loans for even more savings. I'm going to cover all those in part 2, so make sure that you hit the subscribe button so you don't miss it. If you're buying in Oklahoma, that next video could literally save you thousands of dollars. So there you have it. FHA for low credit and down payment, conventional for solid credit and flexibility, VA if you served in the military, USDA for outside the metro with 0 down. If you watch this whole video, you already know more about loans than most first-time buyers walking into the lender's office right now. And if anything in this video helped you, please hit the like button, drop a comment, and tell me which loan that you think fits your situation, or just ask me a question. I do read every single comment, and if you've got someone that's buying a house in Tulsa, please send them the video. This could change the trajectory of their finances. And just to wrap this up, as a simple reminder, if you're ready to actually start the conversation, my Calendly link and contact info are all in the description below. I would genuinely love to help you figure out which loan is right for you and connect you with the right lender. And as usual, remember guys, whatever you decide, I am in your corner. I'll see you all in part 2.